Yesterday, the one and only Anna Kelly, REI mom, put out a very detailed post on Facebook, which I'm lucky enough to be one of her friends, so I saw it. The net of the story is she fears stagflation and that we may encounter a lost decade. I thought what we should do is go through why she thinks that, the policies that could make it go one way or another, the risks that she sees, and ultimately close with what the heck you, yes, you, the person watching this, should do if we are going to have a lost decade or stagflation. Anna, that was a very detailed and long post. I applaud you for putting those together. So bring everybody on board. Why a lost decade? Why stagflation as your base case?
Sure. Will start this with, this is going to be kind of heady, a lot of economic data, but the key is, hang on till the end about what do you do about it if I'm right, right? And along with my base case being kind of a flat decade and basically a stagflation-like decade. Doesn't mean there's not necessarily some pockets of growth, but it means there might be some volatility along the way and pockets of growth and pockets of opportunity, but that by and large, I see at least the US economy and probably more so even globally being basically flat. In other words, we're not going to have this huge expansion that everybody's hoping that now that Trump's in office, maybe we get back to a really robust economy, raging stock market, raging real estate, and they're hoping that this happens really quickly. I do think the policies of the Trump administration are very different than the policies of the Biden administration, although Congress is still bipartisan, and there are economic theories that we can talk about that some congressmen hold, especially if they're on the left, and others might hold if they're on the right. So the fact that we have so much polarization politically, in addition to people, and polarization that I think a lot of people are surprised by or don't even know in the economic world as to what are our problems and how do we get out of them, it means that it could take a very long time for our governments to even agree on what the right course is for the future. And that in and of itself can take time for them to come to an agreement and for their policies that they're going to implement to actually kick into place. So part of the reason I picked a decade for kind of this flat stagflationary growth is the fact that our problems that we have today are not easy to get out of. We're not going to have one politician that's going to save us and make it all right. There is a combination of many, many, many factors that impact growth and inflation and employment. And those are really kind of the key things that governments try to look at. They want to keep their country citizens generally employed. They want to keep the economy growing. And in order to do that, they implement lots of different policies to try to create growth. And they ultimately want that growth without stoking inflation like we've seen in the past couple of years. And so in order to have those things all happen, essentially you need very strong coordination and cooperation between the executive branch and Congress, and making sure that policies don't violate the Constitution, right? So you can have lawsuits that go up to the Supreme Court and get stuck and halt some of these policies. But then you also need the central banks to get on board, the Treasury departments to get on board with the things that you want to do economically. And getting those things to happen is hard enough, Michael, when you're just dealing with your own country. But when you are in a globally independent world who, since Bretton Woods, my whole lifetime has been interdependent, and things like trade balances and currency balances, taxation and tariffs, the UN and the IMF, and countries that have more giving to countries that have less. They're very interdependent. And so if you're going to make a major shift in policy, which is what Trump wants to do, and we'll talk about that, you've also got to consider the global impacts of those changes. And they cannot happen very quickly without creating significant pain for other countries that have been dependent on a system working the way that it has for decades. And so the reality is these things take time. So I didn't just pick 10 years out of my hat, but when I think about how long we have relied on the types of economic policies that we have in the United States, and how bad our debt is, which is a big, big issue, and how much we rely on having that global currency, that global reserve currency, I realize that these things are probably going to take multiple administrations to get through if we are to reverse course. And so a decade was just a time for me to be able to look out and say, this isn't going to happen in the next 2 to 3 years. It's going to take a long time. And I think we need to be prepared of the realities of that, because the other thing about a decade, and then we'll get into the details, is that, there's been social scientists who've talked to people and looked at, kind of our optimism or pessimism about the future. And for the most part, human beings don't look back more than about 10 years. And they think whatever we've experienced in the last 10 years, it's just, this is the new normal and it's always going to be this way, right? So we had a decade generally with obvious bumps in the ground and a real change at COVID, where generally we had really low interest rates. Asset values continued to go up as we recovered from the GFC. And then post-COVID, we had this crazy, scary time, but it was followed by government's going to save us. They're going to give us a bunch of helicopter money. We all got money in our checking accounts. Even if we made a lot of money after the government was shut down, asset values went way up, stock portfolios went up, savings rates went up. And for those that have money, they've done really well over the last couple of years. But for the 70% that do not own a lot of assets, financial assets, they're check to check. And then if you're in the middle income or lower, you're really struggling. And so the optimism and the pessimism, and this was one of my points on my post, definitely is different depending on where you are socioeconomically and where you are politically, and your experience over the last several years is going to make you think that the next decade's going to be just about the same. Or if it was really bad and you blame it on, the Democrats and now you're a Republican, you might have so much hope and optimism that might be overblown. And so you've got to be careful not to look only back at the last 10 years, but to say, what does history tell us further back? And then what that we know about the government and how they react to financial crises, does that tell us about what they're likely to do in the future? And then how long might that take to change? And the reality is, I think that we are in a very, very different era than what we were even 10 years ago, even during the GFC, and that the risks of something breaking as we try to make significant changes going forward are high, and therefore there's volatility that is high. That doesn't mean I don't have optimism. I do have optimism, and I'm hopeful that we right the ship, that we learn from some of the financial mistakes that both the US government and the globe have made, and that a decade from now, things get better. That is my hope. So I say all of this, stagflation is a bad thing. It means that you don't have very good growth and you have higher than expected inflation. And so I think it's important to kind of talk about what are the kind of key components of global finance that impact how well citizens of a country do or citizens of the globe do. And
let's break down a couple of things just to kind of orient everybody where we are today.
Yes.
Right. Because we are talking about the next decade. So let's talk about GDP first. Again, was right the early part of your post. If you just look at the top line of GDP growth, it's, very good, right? It's 3%. Historically speaking, the US has been around 2%. But your point here is, it's somewhere between fake and a sugar high. It's very much been led by the government.
Yes.
It's not something that will last long term. If you back out the government, we've been contracting.
Yes.
So again, government spending can't continue as it was because that just leads to bad things, right? Really, really
Absolutely.
bad blow up. Next is the job market. Again,
yes.
The job market, again, at the surface level, frankly, looks amazing. right? I think the last reading was 4.1%. But there are certainly factors underneath that show pretty big fissures, like we lost 1 million or 1.2 million full-time jobs. There's the most people with 2 jobs on record. There's a lot of, the duration of unemployment is the longest it's been in the last 4 or 5 years, and I fear going longer.
Yes.
And then there's inflation, right? I don't understand why the market is celebrating inflation when, if you look at the trend line over the last 3 or 4 months, it's up, and we get a PCE reading on Friday that it too is expected to go up. Now, as an economist, I understand the base effect. We actually have 3 months in a row after this month that inflation could appear to be going down. We do have a president in place now that's drill, baby, drill, clearly looking to take oil lower. And I think it's down about 5 or 8% since he's been in office. Oil isn't everything.
Right.
But
yeah.
So there's the surface level of GDP, jobs, and inflation. And then there's like reality. And I think they tell 2 different stories.
Absolutely. Yeah. And those are the key 3 components that, that I wanted to explain. GDP, some people don't even know what that is. They just hear, oh, it's a good number. It means growth, right? But GDP, seriously, GDP basically is the receipts of the United States and what we're producing, whatever we're selling, goods or services. It's how much is coming into the country, into its coffers, right? And so GDP is gross domestic product. And so generally speaking, countries want us to have positive growth. So in order to continue to have people who are doing well, who are employed because their companies are doing well, you need growth, you need sales, you need people to continue to sell stuff and people to continue to buy them at prices that allow slow enough growth that you don't end up having too high of prices and then people stop spending and that slows growth. And you don't end up with too low prices where people keep spending and then that spokes inflation. And so the government is constantly trying to make sure we have just enough growth that it exceeds inflation. And that has been, the government's mandate and the mandate of, the Federal Reserve for as long as it's been here for a very long time. And so in order to have good growth and low inflation, you need steady employment of your people. And you need those people to be spending, but not spend too much. And so generally what the governments do is if they start to see that prices, like people are spending, there's too much growth, because we have these cycles that go in these peaks and the trough, and you start to expand. And that means you have a country that's growing. And then you get to a place at the end of every cycle where suddenly the growth is so strong and people are so optimistic, they're spending so much, you end up with inflation. All of a sudden people can't spend as much, they start to pull back, and all of a sudden the Fed's like, we've got to pull back interest rates, pull back the low interest rates that stoked that expansion. We got to start rising interest rates to get people to stop spending as much so we don't have mass inflation. And then those increases in interest rates usually cause businesses to stop investing, to stop hiring, people to pull back, people can't refinance debt. And that usually means you hit a peak and you start to contract. And the bottom of that contraction, when growth is slowing, usually ends in a recession. And that just simply means we have no growth. It's usually 2 quarters of negative GDP growth, going backwards for 2 quarters, although there's lots of things that make that either called a recession or not. And then you have a bottom. You usually have a lot of people who lose jobs. At the end of a recession, you start to see unemployment really rise, but you also start to see a lot of bankruptcies and a lot of the overvalued assets that got hyped up during that expansion start to fall. Everything's kind of wiped out and reset, and then the government starts over with trying to stimulate the economy again. And they do that by printing money, giving it to its citizens, lowering interest rates to get confidence back up and to start the next expansion of growth again. And so the reason that the Federal Reserve looks so carefully at employment and at GDP and inflation is they're trying to get that balance right and to get rid of the high highs and the low lows and try to keep the economy stable. It's never really worked very well that way.
One would argue they were actually accelerating the ups and downs versus.
Exactly. And that's really where it comes down to why economic policy is so important. People don't really understand the extent at which government intervention in producing growth and trying to, keep prices and employment stable actually generally go too far and actually cause the highs and the lows that we're experiencing. And therefore, the policies that our administration, both the central bankers, Congress, and the US government, let's just say, the policies that they choose to implement at times of highs and lows, more so importantly than in times of stable growth, are really, really critical to where our country goes. And so we have seen really a period of time, really since the GFC, but also especially on steroids since COVID, where the reality is where we are today is based upon the reactions of the government to stimulate the economy out of crisis, both the financial crisis and COVID. And those policies essentially were, let's spend as much money as we can. Deficits don't matter. In times of crisis, we got to do whatever we've got to do to try to stabilize the economy, get people back to work, get businesses open and investing again. And then inflation's kind of something they just watch, but they didn't really think we would have periods of high inflation anymore, even if we printed a lot of money and went into a lot of debt. My next post is going to be about modern monetary theory, and we can go into that in another discussion because it's quite complicated. But essentially, the theories are of the US government and global governments today, the theories upon which we've operated at least since 2009 have been under modern monetary theory. And it's let's do whatever we have to do. The budget doesn't matter. We'll pay it off, or maybe we don't have to in the new theories of money, but we'll just put as much money into the system as we can. And that includes giving households paychecks like they did post-COVID, giving companies paychecks, telling companies, keep your people employed and we will give you money in order to do it. That's what we call helicopter money. They push so much money into the system and then they drastically cut interest rates to get people to borrow so that they can spend, to get companies to borrow so that they can spend. The unnatural consequence, or the natural consequence of that, but that the government didn't really anticipate as much, is that companies wouldn't necessarily take that money and reinvest in the economy. Instead, they would buy back their stock, right? Individuals wouldn't necessarily go out and spend it, but they're going to go invest it in speculative things. And that creates these big asset bubbles where people that don't have a lot of money, they're living check to check, but people that do, they're investing in financial assets and those things have skyrocketed. So you get these asset bubbles, but then other people that got money before they knew that this would stop, they were spending like drunken sailors. That's what Americans do. That's what people do.
That's
right?
one of the metrics you quote frequently on our discussions, and I've pushed back before. I'm going to do it again, and
Sure.
it's not that I disagree with the numbers. I just don't know if there's a big delta over the past couple of decades, and that, of course, is 70% of people live check to check.
Yeah.
That sounds scary, and it certainly is. But when we're talking about the economy and certainly the next decade, what we have to look at is what's the net change. If it was 70% living check to check for the last 40 years, it doesn't matter, right? We've already been there. There's not much of a net change. So that's the one thing that, again, in for most of my life, I was check to check, right?
Yeah.
And I just don't know if there's been any great change in that. To your point, we've always spent more than we took in. One of my most memorable moments from my childhood was when my parents got a tax refund and they both went out and spent it within 24 hours. Well, that didn't work out well because they didn't talk, right?
Sure.
I don't know what the number was. They got 500 and they spent 1,000. Well, that's going backwards.
Sure.
But I hear that and I always go, yeah, but is that worse? Because if it's not worse, then it's not a problem.
Yeah, I think it is worse. But I'll say this. One thing that I probably don't say enough, but as someone, I consider myself conservative but pretty moderate. And when it comes to fiscal policy, I don't think either party has done a great job for the American people, right?
Clearly,
if you look back and you just look at you look at charts of how much the national debt has gone up under each president, it's about the same. The difference is, who did it help? Okay. And so generally speaking, even back since the 80s, and, I like a lot of what Reagan did, financially, to get us out of the horrible 70s, right? But a lot of it, Carter actually hired Volcker. Reagan gets credit for that, but Carter did hire Volcker. But really, since then, the government has started to really aggressively use monetary tools primarily, which is central banks and interest rates and buying and selling securities. But that really kicked off even greater after the GFC. And so what we see is that after the boom of the baby boomers in the 70s, and more people working and more people spending, and that creating some inflation, is we started to see after that growth of the population started to decline, and growth of manufacturing and the Industrial Revolution started to decline. And so US citizens were actually producing less natural growth, really, in my entire lifetime. I'm 50 years old. And so for at least 50 years, both parties in leadership, the government has generally said, we need to use the government to create financial tools that create stability. And so they've been playing with these tools for 50 years. And you and I did a show not too long ago, maybe a year or two. We've been doing this over 5 years, so it's hard for me to remember when. But we talked about inflation. And the reality is, there's some reports that were put out, I think, at the end of 2022. So it didn't include the last 2 years, but they showed managerial employees and hourly employees. And what they showed was, on an inflation adjusted basis, Michael, their salaries, their net take home on an inflation adjusted basis in 2022 was almost exactly as it was in like 1978 or 1979. So the reality is, to your point, going back 40 or 50 years, even with the government spending more money to stimulate the economy, as production and demographics slow and produce less, the government has taken over more of that growth responsibility. Even though they've done that and created some growth just above inflation, the path of growth has gone like this: slowly, slowly, slowly. We as a country produce less growth and therefore have had less inflation. But the reality is, even with the growth and inflation somewhat stable but declining over time, families are actually living check to check, just like they were before. But here's a very big difference. Before, Michael, it was generally one income households. The male went to work, the female stayed home with their children. Now it's 2 income households by and large, and they're still struggling to make ends meet. But over the last 4 years, our cost of living as American households has gone up at least 25%. That is absolutely fact. So while we may have lived check to check before, in a fairly stable but slowly declining environment, with blips like the 2001 crisis, the savings and loan crisis in the 80s, the GFC, highs and lows. The reality is, while we had a debt problem and spending problem before, and humans are going to spend more than we earn, and that's a human problem. It's a societal problem that everyone needs to keep up with the Joneses. So there's, people have responsibility for that as well. But the reality is, we have never been more credit card debt for middle income and below, at the same time that we have lower amounts of discretionary income and higher costs of living. And if you look at the change, averages really skew the numbers. So averages, yes, you're right. We are a society that's lived check to check for a long time. But the facts are, and I don't have a chart in front of me to give you an exact number, and I don't want to be accused of saying the wrong thing, but the wealthier have gotten even wealthier. The poorer have gotten even poorer. The bottom 25%, they are hurting. I see this with my family. I see this with my tenants. I see it with applicants' credit scores and how much they have coming in versus how much they have in debt. And the middle class has shrunk. Some of the middle class has gone up into the higher if they had assets over the last 4 years, like home equity, stock market portfolios, retirement accounts,
Yep.
money in savings. Yes, the baby boomers and those in the higher echelon of income and wealth have gotten wealthier. Middle class has shrunk and the lower class has grown, and they're in even worse dire straits today than they were before. And so that's the difference from
Yeah,
where
well,
we were before.
so let me push back on that as well. So first off, you're absolutely right. It is a fact that we have more credit card debt than we've ever had before.
Yes.
That's a fact. Another fact, which again, I don't think gets shared a lot, is the debt structure that the average American owns today is actually much better than it's been in the last several decades. Now, how the hell can that be?
But
Well,
you're looking at average, and that is kind of the point of my post, Michael. And this is where the arguments are. And I understand the arguments when you look at the aggregate number, right? At the aggregate, just like, people will say we have a strong, stable economy because we have positive GDP that's supposed to be higher than the reported inflation, and we
Right.
have low unemployment numbers. But again, that's the aggregate. So when you look at the aggregate, the top end and how well they're doing skews the realities of the pain increasing at the low end.
Again,
Yes, yeah. I mean, that's just what the data shows. But again, are you looking at the headline data? Or are you looking at the aggregate data? And there's a bit, I'm sorry, not the aggregate data, but the actual data is very bifurcated, and that's the reality.
Oh, there's no question it's bifurcated. I would argue it's always been bifurcated. Where I was trying to go with this is, again, these are all facts. I believe today about 65% of folks own their home, right? That's just where that's been a long-term average. We've gone from 64 to 67. So let's just call it 65%.
Yes.
The reality of today is 65% of the country, at least, so 98% of the people who own their home. Well, step back. 40% of those 65% own their homes free and clear. No debt.
Yeah.
That's
mostly boomers, mostly
doesn't
wealthier,
matter.
older.
Doesn't
but
matter.
Yes, true.
Doesn't matter. Then the other 60%, right? So 40 minus 100 is 60. The remaining 60%, 98% of them have fixed rate debt. Most of those are below 5%, and a lot of them are below 4%.
Yes.
Where I want to go with this is, again, one of the reasons credit card debt might be higher today is the structural payments of debt are healthier than they've been in decades, because lots of people don't have household debt. If they do, it's fixed at 2.5%, 2.9%, 3.1%, 1%. And again, to your point, if you own assets, you're winning.
Yes.
If you're part of the 35 who is renting, it's tough. But I think there's a lesson there.
Yeah.
You have to find a way to own assets. Inflation is a feature, not a bug.
100%. And inflation is a tax that the government wants.
Regressive.
But they
tax.
don't want you to understand that you are paying it. And to the
I
point,
agree. Everybody pays it.
Absolutely. And to the point of the hourly worker and the managerial white collar worker, both having basically no real change through 2022, real change in their incomes on an inflation adjusted basis. It means that the dollar is basically kept pace with wages to some extent. Okay. So yes, at an aggregate, that is the truth. The challenge is inflation hurts the lower quartile, at least the lower quartile, much more than it hurts others. And at times with big asset value increases, these asset bubbles, the middle class and above are doing well. They just are generally. They still feel the pain of inflation. I mean, cost of living up 25% is a lot. It means that there's a lot more of your money that's now going toward the things that you need to survive versus before. There's a lot less money available to you on discretionary spending, which is evidenced in companies like, Dollar General or Dollar Tree, one of them going, or Family Dollar, I don't remember, but one of them went under. It's evidence in the fact that retail clothing stores are going under. The discretionary sector of the stock market, other than Amazon, is in the negative because people aren't spending on discretionary stuff. So that's a little bit of a nuance there as well, where yes, at the aggregate, generally we're kind of petering along. The question is, are the wealth gaps getting worse? are the bottom half struggling more? And not bottom half, but at least the bottom quartile, 30, 40%, they're being left behind. I mean, they really are struggling. But the other question to me is, when you look at where is that health and where are they spending money? We have less discretionary income, not just now because of the fact that we're spending too much and we're a consumer society that keeps up with our, we raise our standard of living to meet our incomes. But now the things that you must have gone up so much that there's so much less discretionary, and that will trickle down into eventually more companies go bankrupt, more companies lay people off. Unemployment starts to go up, and I don't think we've seen the end of that. I think those things are still to come because of the shift in where that spending is going today after the last 4 years. And the reality is that even if inflation comes down, and we've said this on this show, but people still don't get it, Michael. They don't. They think, inflation's not coming down because my cost of everything is still up. It's not going back to where it was unless we have a deep financial crisis and a deep recession. And then things may really deflate. Exactly. Be careful what you wish for. But barring a big crisis that wipes us out and puts us in a deep recession or even depression, we're not going back to where we were 4 years ago. And so too much money in the system. Too much money in the system. And so, the issue for me, again, I'm very blessed. I've made some really good decisions, and your decisions, your personal economy is extremely important. More, probably more so than what the government does, although the government's financial policies and economic policies will impact everyone. But if you have assets, you've done well. But a lot of people don't, Michael, and they haven't done well. And so my heart goes out to them. The reality is, even if we got inflation down to the government's preferred 2% growth per year, that's 2% more tomorrow than it was the year before, and 2% more the next year. So our base is starting out where the bottom quartile of our economy isn't going to likely have their wages keep up with where they already are. We hope that some policies that are stimulative will help them. The reality is both Democrats and Republicans have done a terrible job taking care of the bottom quartile. Regardless of their attempts and their policies, the wealth gaps do continue to grow. And so I think it's just important to understand, as we talk about these things, that this is not doom and gloom. This is not the entire world is all going to go bankrupt, but I do believe we have asset bubbles. And so to your point about the middle class and upper class doing well, the baby boomers doing well, if anything pricks that asset bubble, housing values tank, the stock market tanks. For the younger people, the 35s, and below, a lot of their assets are Bitcoin, and stock market and meme investing, and they've done really well the last several years. They're also the ones kind of delaying home ownership a little longer than before. But your retirees and your boomers, Michael, who have a lot, there is more of their money today in the stock market than ever before as a percentage of their income. And so if you have a stock market correction of 30%, a lot of the higher middle class to higher in wealth will also be wiped out. And then that will also put more strain on the economy and our wealth, potentially incomes if there's a lot more layoffs. So my point about a 10-year kind of stagnating economy, not a whole lot better, not a whole lot worse, but just kind of stagnating, is that there's so many things that could pop these asset bubbles, could pop the market, and stoke some type of crisis that when it does happen, if it does happen, I think it could be worse than what we're prepared for if we're complacent in thinking things are fine, we're out of crisis, GDP's fine, unemployment's fine. We haven't seen all the effects of these policies yet. And so a period of stagflation or stagflation-like flatness can have higher highs and lower lows than what we're used to, and a lot of volatility in between. So my point is, let's not get complacent because the aggregate numbers look okay, because the average numbers look okay. There is a very bifurcated and propped up economy that's propped up by government spending that cannot continue. It cannot continue on the path that we're going. without some big impacts on society, because our US debt is so high from these policies. The interest that we pay on this debt is so high and will continue to grow if Treasury market investors demand higher rates for the risk of more inflation or more US government debt that we can't pay, that could cause significant meltdowns in the markets and really bad consequences for the US population.
Yeah, there's a book folks should go read. Ray Dalio. I would read his first book, Principles. That's the one I would read. He's done a couple of books, and I hear another one's coming. There's one area that you put in your post that I will admit to never being concerned about before, but given the run rate of not necessarily the top line number, but just how much we're adding every year, the U.S. deficit I'm referring to.
Yes.
That's a problem. That is eventually, I mean, because again, it doesn't bother me. I don't know what it is, $38 trillion. That number doesn't scare me. What scares me is we've added 1.2 and now we're going to add 1.4 and then we're going to add 1.8. And then, that exponential curve is only leads to a horrible outcome.
Absolutely. And here's the thing, and this is what I'll go more into, in a future post, and hopefully we can have another discussion about this. But, coming back to debts and whether they're a problem, over the last, at least since GFC, most of the government economists advising our government at the federal level as well as at the state level are what we call modern monetary theorists. And so what modern monetary theory generally says is budgets don't matter. Government's responsibility, again, is to keep all these things equal and somewhat growing, employment, inflation, GDP. And we can go into as much debt as we want, and we never have to pay it back. Yeah. So they don't worry about the debts. But part of their theory relied on a couple of ideas. One is because demographics are slowing, as we talked about, people are having less kids. That puts deflationary pressure and it's less growth naturally. So the government is going to have to create that growth by creating more debt. But they also say that because it's deflationary, inflation will never be a problem. We don't have to worry about inflation because people aren't going to spend. And if they do, and inflation gets too high, their solution is we'll just tax more. Because if we start taxing people and corporations more, especially those with assets, things like let's go after unrealized capital gains instead of realized capital gains, we will slow the spending of the upper tier. So that's going to put some pressure to lower inflation. And we will then essentially take that tax dollar to lower inflation to help pay off some of the debt. And that'll keep confidence in the US Treasury. And because they can keep inflation under control, they said it's no problem because we'll always have the central bank keeping interest rates low. And as long as the central bank keeps interest rates low and the US Treasury markets have confidence in the US because we have this growth with low inflation and we're paying our interest on our bonds, the US Treasury markets will also stay really low. And so they depend on those things working. The reality is this post-COVID exercise, and really all the way back to the GFC, has shown us that inflation can happen. It does happen. It's hard to get down. It's hard to get the topper echelon to stop spending until you produce those tax cuts and those tax increases. And those tax increases are so unpopular that you can't get both parties to agree to do it. And so the theory has backfired in reality, Michael. And the reality is, even though the Fed has gotten some, I'll give them some credit, they've gotten inflation down to under 3% generally. And that's split. There's some areas of inflation that are below 2. There's other areas that are very sticky and probably will not get below 3. Things like insurance, health insurance, homeowners insurance, housing costs. And we can argue housing costs, whether they're really coming down or going up or whatever all day long. But essentially what they've seen is inflation is hard to get down to the 2% number that they need in order to be able to stimulate a little less than 3% growth. Why do they want to? Because they can't stimulate growth currently above 3. So they don't want inflation above 3. And so the theories have backfired, Michael. And so what they're faced with now is they have so much debt and they've had to issue treasuries at much higher rates than they did before, which means the cost of the interest on that debt has gone up so much that if they can't raise taxes, and now that the Democrats are out of leadership and we have Republicans that want to extend the tax cuts instead of raising taxes, their plan for funding it and getting rates back down is taxes. Now they're not going to be able to raise taxes. And so now they've got a very sticky situation where the Fed can't really cut interest rates because inflation is higher than what they want it, but the US government can't afford the debt payments. And if we're going to grow our way out of this, because the options are you either allow a recession or crisis to wipe it out and to stop the inflation. No leader wants that to happen under their watch. Or you cut spending significantly, which Trump is trying to do with DOGE, with laying off government workers, with making it come down. But the only places they can really cut significantly are interest expense, which they can't right now, or defense, or entitlement, Social Security and Medicare. Discretionary is so little that it's not going to make a big enough dent. And so they're kind of stuck, Michael, where the government needs the central bank to drop rates significantly, and they need Treasury buyers to have confidence that the U.S. can produce growth and get inflation down in order for U.S. Treasury rates to fall so that we can start issuing some cheaper debt. And then what do they want to do? They want to go on a spending spree. Even the Republicans want QE. They're going to have to stimulate with a whole bunch of spending and with low interest rates in order to be able to do it the way that we did pre-COVID, where the debt, they hope that the debt kind of stabilizes, that then we can start taxing more and we can go back to normal. But the debt is the main problem. It's more of a problem than just where is inflation today for the consumer, because if we cannot get interest rates and Treasury rates lower, the U.S. simply cannot afford to handle the debt that we have today. And they certainly can't add more debt if we have a financial crisis, like a banking crisis or another pandemic or more wars. They need to increase defense spending. They can't cut it. So the interest on the debt is the big problem. And the fact that the central banks have lost control of the U.S. Treasury markets and Treasury buyers are demanding higher rates is something that is very, very, very difficult for governments to get us out of. They have to essentially restore confidence in Treasury buyers, which are other nations, big hedge funds, some retail investors, so that their confidence is back, and therefore they buy U.S. Treasuries at lower interest rates than they are today. Right now, we're not seeing that. And it's a very big problem that's going to take, I think, years and more than one administration to correct.
Folks, there's a lot more in Anna's post. We're going to skip to the end now and talk about what you need to be doing should we have a lost decade and stagflation. So, Anna, you got a whole list of things. Which one do you want to start with?
Sure. So here's what I'll say. Because of these long-term debt issues that are going to take time, they're going to require shifts in government policy, shifts that Donald Trump has already come out and said we're going to do. We're going to add tariffs. We're going to lower corporate taxes, which means we got to earn money somewhere else, like tariffs. And we're going to try to cut spending and try to grow our way out of this thing. These things are going to take time. Even if all of these policies were implemented, it might take a year, 2 years to start seeing the benefit of most of it, and then even longer, right? But what's going to happen is you could have some high highs and low lows. And so in case we have those low lows, you really need to prioritize asset preservation, number one. And we've talked about this as well. I'm going to put in my old private banker hat. What we used to tell our clients was at any given time, you have one of three main financial goals. It's asset preservation once you have assets, it's growth, or it's income. And at all times in your phase of life, you've got to prioritize one over the other. I would say 70% of the population today, Michael, needs more income to cover their increased cost of debt, more so than they need future growth and appreciation. Younger people, if you don't have a lot of debt, you've got plenty of income, then you might prioritize growth. But in an environment that has a lot of potential volatility as big shifts happen in the economy, you have to first prioritize preserving what you already have. And my recommendation is that you save at least 6 to 12 months of your own living expenses before you go invest for more income and growth. And that is conservative. But times like these, I would argue, call for being conservative. So I made the mistake of early on going into a bunch of debt to invest, right? Well, when cost of debt's expensive and you can't get as high of returns necessarily without a lot of risk, you could have a double whammy. You could lose your money and still have a lot of debt to have to show for it. So prioritizing asset preservation, saving, whatever you need to do to save, Michael. I've often said to me that the key to financial financial wealth growing is to live below your means while you work to expand it. So this is a time to cut back on discretionary spending and to instead save that money. And once you've saved it, you are being paid for the first time in my lifetime, really, as a earning adult, to save money in a money market account or in a CD if you want to do that. You're being paid to save. So save that money. You're still making 4 or 5% on your money. That's pretty good in a volatile environment. The other thing is to really be conservative and think about, if people are struggling check to check and they can't spend money on discretionary stuff, when you choose to invest in growth and income, you need to invest in what people need, not the stuff that they want. Don't go invest in Gucci purses and Gucci as a stock, right? You want to go invest in things like housing, residential housing. If you have the money, invest in things like farmland and energy and things that people need, insurance, healthcare, those types of things. And you want to own assets that are going to go up with inflation, because I believe we will have higher inflation over the long term in certain sectors of the economy, and that government spending is inflationary, and the government will have to spend more over the next decade than what they even are, regardless of the policy. That creates more inflation. So you need to own assets that are going to go up in value over time. Real estate. This is what we do all day, day in and day out. Things like gold, things that have a proven track record of going up over time, farmland, etc. And then as you're investing in those pockets, you're going to have to do really good deals that actually pay you a good enough return for the risk that you take, relative to what you could make in a savings account. So if you're going to do a deal and you're going to buy a property and your goal is income after you've saved that money, don't go do something that's going to give you a 3% return on your money, Michael, when you can make 4 to 5 in a savings account. Only do great home run deals that you're getting a good price, or you're financing it creatively so that you get a good interest rate. Make sure that you're paid for the risk that you're taking. Then the other thing is to watch what the government actually prioritizes. What are they giving tax incentives to build and to do in order to produce growth? It's going to be things like affordable housing. They haven't come up with a plan to do it, but they're going to reward you if you can help with the affordable housing problem. They're going to prioritize AI. They're going to prioritize manufacturing, bringing pharmaceuticals back, bringing semiconductors back. If you want to invest in the stock market or create a company, or invest passively with companies that are doing it, look to invest with companies that are, or in your own assets that target those things that are going to give you the tax incentives, and where you know that even if aggregately the economy is on a flat to slightly declining basis, you are going to choose to invest in sectors that are going to continue to grow, even though other sectors might not. And then the next thing is along those same lines, Michael, is to choose to invest in areas that are investing in those things that people need and that the government is going to prioritize for growth. So, I would not be, I'm just going to throw this out there, I would not be investing in, LA if LA is not going to be investing in the things that the government is going to prioritize to grow. I would not be investing in a tertiary market. I'm going to pick on Oklahoma City that has, more than 10% vacancy if they're not going to bring companies to Oklahoma that are going to cause growth to happen in the area and population growth. So you want to basically be investing in those areas where you do have an opportunity for growth, even if the rest of the country is stagnating. So I think those are kind of the key things. Was there anything that I missed?
Well, I think the last thing we'll point out is your number 6. Again, I think a lot of people follow the crowd right? A lot of meme coins. It seems to be in today's social media era. Not that we weren't guilty of it as Gen X with the .com era, but be very careful following the crowd, because the crowd is often wrong and sometimes very wrong.
Absolutely. And the crowd, by and large, does not understand the economy. And they don't understand what a big shift we have with the change in administration when it comes to economic policy, and how bumpy that could make things. So we basically are still at the top of irrational exuberance, where people that have money are investing in anything and everything with speculation rather than fundamentals. And so if there's anything I could get you to go back to is, yes, if you have money that you can afford to lose completely and it not hurt you today, throw it in the meme stocks, throw it in whatever you want to, AI stocks, if you can pick the right one or whatnot. But you've got to get back to the fundamentals of investing. And that is that when governments want growth and they want stability, what are the assets that historically have proven to be things that people need and that the government prioritizes? And the fundamentals of investing is investing in things that you know people are always going to have a demand for, and finding those pockets and jumping in. Don't chase the shiny object, what all your friends are going to do. And it's especially important right now, as we are clearly in an everything bubble, that just look at what happened yesterday with the I can't even remember the name of it, but the Chinese AI company, DeepSeek. You know, that was announced and suddenly NVIDIA came down significantly because everybody's invested in AI and they're thinking it's so expensive and the PE ratio is crazy, but it's going to take over the world. And when anything small like that spooks the markets and a stock can drop, I don't know, 17%, I think I heard, in a day, and that leads the markets, the bubble can pop very easily. So just to be very, very careful and diversify your holdings into things that are not correlated. So for example, what did people do yesterday? They went into more bonds. So the treasury rates actually came down because they were spooked about the stock market. So they went into treasuries. And so those things are kind of non-correlated. So diversify, but with the fundamentals of investing, stick with the fundamentals. Don't speculate. We're in an era, the last couple of years, Michael, where people are speculators and they think they're investors. Get back to the fundamentals. Buy real estate, right? Buy real estate.
Exactly. Buy great deals. Folks, at the end of the day, Anna's been with us for 5+ years, always bringing the heat, always bringing the value. If you want to see more about her, she does have her own playlist, or you can go to AnnaKellyInvesting.com. Thank you so much. We'll talk next week.
Thank you, Michael.